8 seconds to go. I'll let the screen do all the talking. Looks like Raymond is in for a good grand start. Two reports coincided. One from Jeffrey, second from Motilal Oswal. I mean, magic is the word when it comes to Raymond's. Okay, what do we have now, ladies and gentlemen? A brand new day, solid market breadth, rub of green on the Nifty, and a good start for mid and small cap stocks. Another 1% higher for mid and small cap stocks. Now let's start rotating it with railway stocks. That's where all the price action is. RVNL, IRCTC. I mean, there is just hullabaloo happening in that entire space. IRFC 7% higher. IRCTC, it's a laggard today. RVNL, the whole Titagar 839. So this entire I won't use the word euphoria or bubble, but all I'm saying is this entire FOMO or this mad rush of liquidity continues in some of the railway stock. That becomes the first port of call. Geo Financial, circle limit is out. Where is that one? And then Raymond's, where there is it's not upgrade, but two brokerages now have a buy on Raymond's after the price hike. One Motilal Oswal, second I think is Jeffries, and the stock reaction immediate on your screen, up by about 7.5%. Anisha?
Well, yes, a very strong start for Raymond and a good start for the market as a whole. 1,500 stocks advancing. Of course, in terms of sectors, it's PSU banking names which are leading. So smaller ones at that, a UCO Bank, a Central Bank, Punjab Sind Bank, these are the stocks. And then real estate pack is also building on to gains. Look at Lodha, that's opening up with a gain of almost 2 to 3%. From the broader markets, watch out for Nazara Tech. That stock is higher by 4% after that solid rally that we saw yesterday. There's a fresh intimation from the company that there's another board meeting on 7th of September wherein they are going to do preferential issue of shares. So on account of that, that stock is opening high by 4%. Suzlon continues the up move. IEX, on account of that operational data which was out, is also in focus. And then we also have names like Yes Bank, Renuka Sugars continuing the momentum. On the losing side, it's Finelix Pipes, which is down. 5-star is seeing some profit booking. Aptus and Dr. Reddy's, wherein Dr. Reddy's has clarified to the exchanges that they do not want to comment on market speculation. But for now, that stock has opened with a cut of almost 1.5%. Let's take a look at what Cipla and Torrent Pharma are up to as well, because these stocks continue to be in focus as well. Cipla continues the momentum on the upside, almost 1,300 lined up for that one, and Torrent Pharma too doing well for itself. From the broader market, let's just pick MAS Financial, because that stock was showing an uptick of almost 8-9% the last time I checked. No news store that I can spot on that one. But GMR Power is the other one which is opening with a 10% gain. And then SpiceJet, on account of that preferential issue and money coming in, is also fairly excited about.
Oh yes, indeed. And looking at the screen for now, it's a flattish move, but at least it's heartening to note that we're above the 19,500 mark. Kunal, broader markets yet again outperforming. The breadth is skewed in favor of the gaining side. What would be your first trade?
Yeah, so looks to be an attractive market yet again, and the action and the theme would be more towards mid caps and small caps. I think that's the tone for the market so far. AB Capital is something which looks attractive. So the stock has bounced off from that 180 mark. I think yesterday it managed to come back towards 188 or 189 levels. So looks attractive and would probably expect a retest of the 200 levels for AB Capital over the very near term.
It's above the 40,000 mark for the mid cap index. Naresh, does this assume any significance? And take us through your first trade. You're on mute.
The mid caps have continued the momentum. We only need to look out for a day where we actually see a pause. So the stock for the day is I continue to like NHPC, adding onto the position, a defensive bet here which could do well.
All right, Dr. Reddy down, Cipla up, Torrent Pharma is also racing along. Ashwini Agrawal joins us. Let's take our conversation forward. Let's understand what he makes of the market right now. Ashwini, good morning. Thank you for joining us. Ashwini, every time it has appeared that markets are looking stretched, time to take some chips off the table, whether it's flow, whether it's momentum, it surprises us. How does one deal with this kind of a market? Because if you've stayed invested, you're making maximum gains. If you're making opinions, judge the reality of the market, then you are not participating.
Nikunj, this is a very typical bull market. So bull market, in the midst of it stops making sense at some point. In your opening market comments, you spoke about what the rail stocks are doing. And that's a clear indication to me that, this is a typical bull market. So stock prices in some areas stop making sense. And that's the nature of the beast. So either you continue to participate, stay invested and enjoy the ride, and be prepared that, at some point in time, the narrative will turn. When and how, it is only with hindsight that we will find out. I think having said that, what I would also add is that in my 32 years of following the market, this is possibly one of the few times when the macro narrative in India is very, very attractive, and it has never been so attractive, possibly for a brief period in 2007 apart. So obviously, this becomes a huge attraction for macro analysis and for overseas investors. And we live in a market where local investors, have a local bias, home bias, which is there in every market. But we have restrictions on capital flows from outside, investing from outside India into markets outside India. So the combination of that kind of makes it an environment where money is chasing the same ideas, the same stocks. Paper supply has improved of late, but it's still not adequate to absorb all the money that's available. So I think it's a bull market, and you have to just stay invested and enjoy it. And if you don't agree with some of the prices, take some money off the table and don't look at it. I mean, be happy with the fact that you've made money.
Ashwini, how would you analyze, let's say, railways and defense? The big picture, the macro, the government intervention, everything is great. But are markets pricing in FY 27, 26, 28?
Yes, absolutely. I mean, I think, time and again we've seen whether it was infrastructure in 2007, 2003 to 2007 rally, and whether it was power or whether it was coal. At various points in time, we've seen that when you're dealing with significant policy related issues, and when you're dealing with a buyer that is the government ultimately, there tends to be many a slip between the cup and the lip. Now, this time could be different, but those are the most dangerous words in the world of investing. So my thought process here is that I'm not really going to chase this dream. And historically, we found that the further out into the future that you're willing to discount, the more are the chances of disappointment. So obviously, some of these prices have stopped making sense a while ago, and it's a bull market, so who knows where these go? But I would be very, very worried as to what the outlook for these stocks will be at some point.
Okay, so not chasing momentum, not getting that FOMO, but this entire euphoria that we're talking about, Ashwini, is quite visible in the broader markets. The mid caps and the small caps are rallying quite a bit, and has been doing that while rest of the market was even consolidating. Do you think it's getting a bit frothy and toppish?
In areas. So again, if you go back to the previous bull rallies that we've seen, if you go back to 99, 2000, or more accurately between 98 and 2000, it was pharma, media, and IT, right? So those stocks ran away, rest of the market did nothing. If you look at 2003 to 2007, or more particularly 2007, 2008, it was all infrastructure, real estate, and a couple of these SOTP stories that did really well. So, at different phases of the bull market, different sectors catch the fancy and they become super expensive. And there are parts of the market that don't participate. I mean, look at frontline financials, for instance. A lot of the banks, large banks, have done nothing for 3.5 years. And as Nikunj was saying earlier, the environment for the banking sector has never been more constructive, at least in the last 10 or 15 years. So, to imagine that some of the large banks have nothing to offer, and defense and railway stocks have everything to offer, kind of sounds too extreme to me. So I think the right thing to do at this point in time is to take money off the stocks that have become expensive and look for areas where you have significant downside protection. But I will also add that in the mid and small cap space, because the underperformance over the last decade has been so extreme, there are still stocks which are available at very reasonable valuations with good growth prospects. So it's not that I'm negative on mid and small caps. It's just that I'm increasingly becoming much more selective than maybe 6 months ago.
Ashwini, where do you think, or how do you think the 2024 election cycle will start impacting the market in terms of opinion, anxiety, curiosity, and more importantly, volatility? What role will that cycle play before?
It's very difficult to answer that question, Nikunj, because we at this point in time don't even know the dates of the central elections or the various state elections. There's a conversation going on that should they all be held together. So let's see, what comes out of that. There were some rumors in the middle of last week, if you recall, that the general elections might happen as early as in December or in February. So we have no visibility. I think the consensus opinion at this point in time is that there is no question about the BJP government not coming back with an absolute majority, maybe not as large a majority as it had the last time, but within a majority nonetheless. I think if that narrative starts to change, there will be some nervousness. But at this point in time, there don't seem to be any signs of that. So I think, from a political noise affecting markets, you definitely have to see significant traction in favor of the India combined, which is not visible today.
Okay. Where have you been shopping off late?
Like I said, financials, some of the larger ones, taking money off the small caps and putting it to work there, with the hope that over the next 3 years.
That was 2 years ago you were shopping. That was the last sale. That was like 2 years ago sale mein kharida tha.
No, I continue to, if you look at the frontline banks, you look at an HDFC bank or even a Kotak Mahindra bank or, some of the other names. I mean, they've done nothing for a period of 3 years. Valuations have come off purely due to elapsing of time. And the premium that they enjoyed has contracted significantly. And I think, I think it makes sense to look at names like these. I do have a position in HDFC Bank. For due disclosure, but I would say that it makes sense to have a position to build exposure to names like these where you have downside protection and fund it from smaller and mid cap names where the pricing action appears to be extreme. Having said that, I continue to look for ideas in the small and mid cap space because I think the overall economic growth environment in India is going to be very conducive. And if that is the situation, many of these smaller companies will offer you 20-25% earnings growth over the next 5 years, and not all of it is priced in. So I think, it's a combination of both. I do worry about the extreme price action in certain areas and certain sectors, but at the same time, I continue to find opportunities both in the lagging frontline names with good prospects, as well as select small cap industrial names or dare I say, even some of the services names.
Buying banks because they haven't done much, at least over the last many months. Are you buying IT as well with a similar thought process? Of course, some of the names have run up, but what's your take and where does the preference lie within IT?
So, I have been sniffing around at IT for a while. I thought, I'll nibble into it prior to the June quarter earnings results, and looking at the results, I was glad I didn't. So I don't quite understand what's driven the rally. The narrative has not changed. I think the growth environment still remains fairly challenging for the IT services companies. But yeah, maybe the valuations had become cheap enough. And that's the reason why IT is attracting attention. And for most foreign investors who've poured in a huge amount of capital into India over the last couple of months, the large cap IT is an area of extreme familiarity. Valuations are not expensive. There is a very good dividend yield support, so it makes sense for a large institutional inflow to get parked there. So that's what I'm thinking. But I'll still wait for the September results commentary before taking a position there. I think the challenges haven't dissipated quite yet.
Ashwini, you are not alone in that. Even I am as puzzled by the rally as you are, because in terms of the commentary that I heard in the quarter gone by or the earnings, nothing to my mind warrants that kind of move. But you have also been positive, Ashwini, about the textile stocks, right? Could you talk to us about some of the names there and what's the rationale behind being positive? And is it the entire value unlocking, the real estate vertical kind of stocks that you're looking at within textile?
No, in textiles, it's essentially the export story that's playing out, and it's the China plus one narrative that's playing out. So first, what we saw was that towards the second half of 2022, we were all worried about the US demand slowdown. And it was a little bit of a situation where the retailers in the US had also prepared for a slowdown, and the demand slowdown didn't happen. So as a result, most of the shop shelves were low on inventory at the start of 2023, resulting in a fairly robust environment through the first half of this calendar year. On top of that, you have the China plus one narrative playing out. You also have some FTAs which have been signed, Australia and the UAE in particular, which is offering some opportunity. And I think over the next 3 years, if the access to EU and UK improves, then I think there is a lot more opportunity there. Again, valuations are attractive even now for some of the textile names. I think the risk of a US slowdown is very much there, but it's not visible yet. So, does the US consumer continue to soldier on and we keep worrying about it and nothing happens? It's quite possible. But I find comfort in valuation. So, that's one area where I had invested at the start of the year, and even in 2022. Some of those stocks have done quite well. So, I think I'm grateful for that. But I continue to think there are value buys there which are available.
In a market like India, private banks, well, they were a mega trend 10 years ago, and I'm sure they will be a mega trend 10 years henceforth. But there are a lot of seasonal trends. For example, luxury was bombed out in COVID. Right now, it is the go-to space. Hospitality was bombed out. Now it is the go-to space. Nobody talked about defense. It's the go-to space. Where do you think right now the ingredients of a making where you may see some cyclicality, little bit of mean reversion, and this really could be the next 2-3 year theme?
So I think, chemicals, especially the downstream chemicals, is one area where I think we should keep an eye on. I'm a huge believer in the China plus one narrative, and India does have significant capability in chemicals manufacture. Chemistry is something that we've done well at historically, whether you watch the pharmaceutical space or whether you watch the bulk chemical space. And I think in India now we have the capital and the capability to manage large size projects. So if you put these things together, you might be early in a chemicals cycle. So the stocks have got sold off over the last 1.5 years because there was a massive COVID pop, and the COVID one-off earnings have now been taken away. So earnings have normalized, margins have normalized, but stock prices have also corrected significantly and have not done well. So my sense is that this is one area where you might see a positive surprise. I continue to be quite positive on the pharma space, where I think there are companies in the export-oriented space and a few in the domestic market space, which are continue to look quite attractive to me. Again, the theme being that the margins have bottomed out, and the China plus one narrative is here to stay. And I think the margins will remain fairly normal from a raw material price point of view, for the next few years, given how soft global economy is. So these are a couple of places where I would be looking for opportunities.
Okay, Ashwini, on that note, we let you go. Appreciate you joining us on the show today. So that's a take coming in from Ashwini Agarwal, looking at financials. That's one space that he likes, and even textiles and some of the other names is something that he's quite positive on. But shifting focus, welcoming on board Mr. Vivek Karve, the CFO at Mahindra Finance, joining us. Of course, the monthly update from Mahindra Finance was out. It was a healthy disbursement trend that we saw. Collection efficiency also continues to be robust. So a largely inline set of numbers coming in, and that's the reason the stock is holding up with a gain of almost 1%. Vivek, hi, thanks so much for making time and speaking with us. I was going through your disbursement numbers, and it's again a healthy set that has come in so far. Is it fair to assume that the quarterly run rate will continue to be around the 13,000 crore mark for Q2 FY24?
Hi, first of all, good morning to all the viewers, and thank you for having me today on the call. While I will not be able to give a very specific quarterly guidance, what we are quite confident about is about continuing of the momentum. So, for example, in the month that just got over, the disbursement were up 15%, and as a result of which the AUM on a YOY basis has grown 27%. So taking the viewers back to the medium-term game plan that we had talked about at the beginning of FY23, we said that we would like to double our AUM over a 3-year period. And I believe we are on track to make that objective come true.
Not looking at a specific number from you, Vivek, but just wanted to get a sense in terms of the pre-festive demand. How's the momentum being? Because the last time we had the conversation, you were talking about how the pre-owned vehicle segment is doing quite well. The rural sentiment was showing quite a bit of uptick. Is it getting incrementally better from there?
Yeah, so if you look at the dealer inventories, the dealers have also been stocking up in order to meet the festival demand, which will start in the early third quarter, I would say. So we believe the dealers are adequately stocked up. We also support the dealers with the trade advance facility, which also is at a healthy level. So I believe the momentum will continue, and as and when the dealers do the retail, we should be able to get a fair share of them.
Early indications are showing that there is very little comeback in the rural economy. Could that pour cold water in all the assumptions? Because when I speak to car companies, they're excited about festival season demand. When I speak to NBFCs, they feel that dealer financing this time will be strong, trade financing will be strong. But the on-ground evidence keeps on telling me something very, very different.
So if you look at the infrastructure spends by the government and the overall macro indicators in the economy, despite the fact that monsoon so far has not played out exactly the way we wanted it to, I believe the demand momentum has continued. And insofar as there is momentum in the economy, the customers who invest in the vehicles because they earn out of those vehicles, they will look for financing. And to that extent, except for a few nervous moments which are more instigated by suboptimal monsoon, I believe the momentum will continue.
Every report I read talks about one thing, that when will the change on ROE and ROA will actually structurally start for Mahindra and Mahindra. You're working on it, but when do we see real evidence of you hitting that sweet growth curve?
Okay, so you will recollect that last fiscal in FY23, we had reported 2.3% post-tax ROA, which led to, I would say, a reasonably good ROE of 12%. And in our medium-term game plan, we have talked about reaching the milestone of 2.5% post-tax ROA, which with the growth in the AUM will also lead us to a 15% ROE. And this is a dream that we had talked about by end of FY25. We stay committed to that.
Okay. In order to achieve that, you will have to start moving from the low yielding loans to high yielding loans. Now we are looking at the landscape getting very competitive. We are looking at cost to income ratios changing. So for you to migrate from low yielding loans to high yielding loans, how will you achieve that?
Okay, so end of the day, it is not about low yielding or high yielding. It is about delivering that post-tax ROA of 2.5%. So what are we doing? So we are building a judicious mix of probably lower yielding but extremely high quality assets and creating a mix of pre-owned vehicle financing. With that, what we will achieve is that we will try to balance the yields. At the same time, we'll try to manage the overall volatility on the balance sheet and also meet the target on overall credit cost and post-tax ROA. So just to repeat, it is not just about moving from low yielding to high yielding. It is more about improving the mix such that we are able to gain that sweet spot of a reasonably good yield and a reasonably healthy post-tax ROA.
Okay. And what about the outlook then when it comes to your net interest margins? Because I understand that you see your blended NIMs at about 7.1% by the end of this year. Does that guidance change given that there is now a stronger possibility of rates being higher for longer?
So if you recollect last year, full year, our NIMs were 7.4%. However, in the first quarter, the NIMs were 6.8%. That was primarily because of anniversarization of the borrowing cost. And as the outlook suggests, we are not expecting any further decline in the interest rate cycle either. However, we are also not expecting a significant increase in the interest rate cycle. So our attempt will be to reach closer to the 7% mark for the full year as we close the year FY24.
All right. Thank you for sharing with us all those growth targets as well as the outlook on M&M Finance. Time for a quick break. Be right back. On the other side, we get you the growth outlook from Home First Finance. All right, welcome back. Thanks for staying on with us. And for now, the markets are holding out. So it is a print of 19,560 on the index. And yet again, yes, the broader markets are taking leadership. I just want to check in as to what's happening when it comes to individual sectors as well. While IT is taking a bit of a backseat, when I say backseat, I mean just about flat. You've got media on the flip side that's doing well. PSU banks, FMCG and energy, those are some of the stocks as well that are buzzing away in today's trading session. Within the broader universe as well, names like an MMTC, Raymond, yep, Magic Wand, Central Bank, UCO Bank, Zensar Tech, those are some of the interesting movers. And Nikunj, just to go right back to that point that we were making with respect to whether or not this is some sort of a decisive move now on the upside after yesterday's breakout and where banks and IT stand.
See, my view is that for Nifty to break out, you need support of HDFC Bank or SBI or perhaps both. Until the time that's not going to come, you will not see a decisive move, at least in benchmark indices. Look, IT is no longer sold out. So that comeback in IT is done. Reliance has already done its bit. ITC is moving into some kind of a sideways stroke hibernation after that giant rally of 2021 and 2022 and early 2023. So you need something which has a 10-12% individual weightage. That's from Reliance, which is not doing anything right now. Then it's HDFC Bank, which has to chip in, which is underperforming. And then you got ICICI Bank. So combination of large banks have to kick in for index actually to go higher decisively. But a push, I think right now is largely global in nature. And the global push, typically when that has happened, it is either in high risk stocks or high beta names. High beta names like banks, I think, are the one where I would say that the next push really could come in terms of the market. But a lot is changing on the financial market per se. And let's understand especially the home finance market or the home loan market, what is happening there. Manoj Vishwanathan, Managing Director and CEO of Home First joins us now. Manoj, good morning. Thank you for joining us. Let's first understand the scenario because there are contradictory signals which we keep on getting, which is that the urban income is strong, but the rural income is not strong. It is no longer looking all that hunky-dory when it comes to low-cost housing. What is your understanding of the scenario?
See, the understanding on the ground is that the affordable housing itself is a kind of a semi-urban or an urban phenomenon where people are, rural people are migrating to cities, looking for livelihood. Living for a couple of years and then, looking to build or buy their first home. So that is really the phenomenon that we are tapping in affordable housing. And there is no let up in that. In fact, with this whole push into manufacturing that India is taking up, there are a lot more jobs being created, a lot more livelihoods being created in the emerging cities, smaller towns as well as in the periphery of larger towns. And all that is giving rise to a lot of demand for affordable housing. On the ground, we are not really seeing, any let up in demand.
What is happening to your cost of borrowing at a time when interest rates, when they were supposed to go lower, looks like because of high inflation, they're unlikely to go lower. Do you think this time around it could be a challenge in terms of managing the liability and the cost of borrowing, especially when bond yields have not come down? Manoj?
I think I lost you for a bit.
Cost of borrowing, how do we see that moving?
Cost of borrowing at the moment, we are, what we are seeing is maybe, you can see a stable period. I mean, it has already gone up over the last year, by probably about 100 to 200 basis points. And at least from the inflation figures and overall stance of RBI, what we are seeing is, a period where it will be stable for maybe a couple of quarters before it will start going down.
Okay, fair enough. Morning, Manoj, and wanted to also discuss the outlook with respect to the latest note that came in from Jefferies talking about borrowing getting less competitive given now that HDFC Limited is no longer borrowing heavily, especially from NHB. What are the trends that you are seeing here? How are you expecting the environment to really evolve?
Yes, we are seeing some early signs of that. There is more, interest from banks to lend to companies which are, in the mid-sized category like ours. Earlier, a lot of those funds would probably get, directed towards larger companies like HDFC. So we are seeing early signs of that. I think that's something that is good for, companies which are well rated like ours, and which are growing at this stage.
My question specifically is your AUM growth. I'm looking at the numbers here. Your AUM growth is growing at about 30%, north of 30%. But now the base has also increased. And base in last 3 years is almost 2.5x. Can you maintain this 30% growth on this large base?
The growth largely comes from, a distribution expansion. That is, entering new geographies, as well as from gain in market share. And these are, two things that will have headroom at least for the next 5 to 7 years. So which is why we don't see, any hesitation in saying that we'll be growing at about 30%. At least for the next 2 years, there is clear visibility of the 30% growth, because it is just a simple back calculation of, how much we are disbursing versus how much the portfolio is eroding. So from that calculation, we are able to, establish that we'll grow at 30%. Post 2 years, we will have to see how the market is doing, how the economy is growing, etc. Because affordable housing growth is something that is very, very strongly correlated to job creation, increase in incomes, increase in urbanization, a lot of macro factors. Post 2 years, we will have to see how those factors are doing. But at least for the next 2 years, we are very comfortable in saying that 30% growth is visible.
Your 30% of your total book is non-salaried customer. Isn't that a risk? And how are you managing that risk?
30% is non-salaried, and so these are, small businesses, SMEs, MSMEs, which are there. And, from a risk perspective, these are all customers who are building or buying their first home. So in that sense, they're all fairly attached to the property. We also saw, or got a glimpse of how this segment will play out during the COVID period. And we saw that almost all customers were very attached to the property, and they would go to any extent to, make sure the installments were paid. So they would prioritize the installments over everything else. So this phenomenon is something that we saw in COVID. So we are very comfortable with the, self-employed sector.
But my point is, it's not easy to sell collateral. It's not easy to perhaps, and God forbid, if you have to really re-put that collateral back in the market, a 10 lakh rupee house, a 20 lakh rupee house, it may just end up becoming like a large process. So while you can secure your loan, recovery becomes a challenge. How are you managing that risk?
Recovery has the process of recovery has been fairly streamlined, with the SARFAESI Act. And today, customers also understand. First of all, the customer segment that we are dealing with has, this segment has become very mature as far as credit behavior is concerned over the last few years. So mostly customers, if they have the capacity to pay, they don't default at all. The default happens because of some extreme circumstances, like, customers either losing their job for a long period of time, or some serious medical condition coming to some family member. So things like that. And at that point, the customer realizes that it is better for him or her to dispose of the home and take back whatever the down payment that they have made. So which can help them to tide over their difficult condition. So that realization comes to the customer. So recovery has never been a problem for us. So it finally comes down to how you can sell the property, and that is something that our company has kind of mastered over a period of time. So how do we sell these kind of properties in the market? How do you approach brokers? How do you do direct marketing on the ground to sell these properties? So that is something that we have understood, and we are able to do very well. So recovery has never been a challenge.
Sure, Manoj, and just before we let you go, I wanted to get a sense from you. In your shareholding, there are a lot of marquee PE investors as well, and this seems to be the season of exits for a lot of them. Is there any conversation that you have had, anything which could be coming to the markets that you can discuss with us?
No, nothing this quarter, and we have a very clear understanding with the PE firms who are our shareholders that there will be a very structured and systematic exit over the next few years.
Okay, Manoj, on that note, we'll let you go. Appreciate you joining us on ET Now Today. Time now to take a breather on the show, but as we do that, a quick check on the markets as well, because if you look at the top buzzers from the trading session today, it continues to be Raymond, which is doing quite well for itself. Indian Railway Finance Corporation continues the up move. Nazara Tech is now higher by around 6%. Devyani International, that's seeing a very smart move in the trading session today, a 5.5% gain coming in, and some of the cement names are also building on to gains. So case in point being Nuvoco Vistas, which is higher by 5%. I think yesterday there was a brokerage note as well that came on it. Zensa Tech, Trident India, these are some of the names which are doing well in the trading session. However, Angel One is seeing a cut of almost 4% given the operational update hasn't been as strong what the street was expecting. But as I promised, time now for a very short break. But as we do that, listen in to the conversation that Avan had with the MD and CEO of CaratLane.
Here we were pursuing them for years because I always believed that Titan, Tatas are a gold standard for trust, and Tanishq is the gold standard for trust in jewelry. This articulation I got from Bhaskar, but the belief and the understanding was certainly there in my mind before that.
100%. It does have that association with all of their brands. And then it was that you were introduced to Mr. Rakesh Jhunjhunwala via Mr. Bhatt. And I believe that he played a very pivotal role in really helping change the business. What advice did he give to you? What kind of sessions did you have with him, if at all?
Yeah, look, his perspective to business is what helped us change. It was up to us to take that on and sort of build on that part. And the kind of personality that he was, you would sit and listen, and you would want more. And I wish I could get more of him today as well. He was somebody who really taught us the difference of, or the transition from Tiger to Titan was actually not an easy transition, because the language that Titan spoke, they didn't know what Tiger spoke. And what Tiger spoke, Titan didn't know. And we were like sort of this guy who's in between, or this firm that's in between this whole thing. And how do you build the same business with the same kind of scale that we were getting with Titan? And how do you understand to sort of build this into a profitable business and sort of focus, and your growth should come from your own capital. You should not have to look outside all the time for capital. All of those things, I think he added tremendous value to.
So